Hello everyone. So once again, I'm going to talk about something new to people who have never attended this class before, and also to talk about something which students have come across in my class, especially those students who have attended my class on financial management. So what is it that I'm going to talk about exactly? Well, today I'd like to talk about the types of loans. Right. We all know what loans are, but as far as many people are concerned, loans simply means that I borrow a certain amount and I know that I'm expected to pay back in time to come. But loans can be structured in different ways, and namely, they can be structured into one, the bullet loan. Now, the bullet loan is a very interesting loan structure, alright, which we will talk about in a short while, and of course, the balloon loan. Okay, and the last, which is also quite common to many people, is the amortized loan. Right. So let me talk to you about the three types of loans and explain to you how they work, their advantage and disadvantage. Of course, not forgetting their uses. So let's begin with the bullet loans. What is the purpose of a bullet? Why would businesses want to use a bullet? Quite simply put, a bullet loan works in this very simple fashion, right? The moment you take on a bullet loan, and if it's approved by the bank, you get the money, right? And throughout the entire loan tenor, you will only be paying an amount from month to month or from period to period, the interest. And the moment when the loan comes to maturity, you will have to pay off the entire principal. This loan has a very powerful advantage. That is, number one, there is no worry about the paying of installments, because all you are paying meantime until the loan is mature, all you are going to pay is just the interest, right? This is good for businesses which may have cash flow problems, difficulty with having ample liquidity. So but for certain businesses, this is very appropriate because they might know that there is going to be insufficient liquidity for the meantime, but then they know for sure that before the loan comes to maturity, they would have the money to pay off the entire loan principal. So in a way, it's attractive, alright? However, some downsides. Obviously, the thing is that when the loan comes to maturity, you have to budget a big amount to pay off the entire principal. So this is actually, in a way, the downside of a bullet loan, because you will have to actually budget for a large repayment amount. And not forgetting also, this large repayment amount would lead to one more problem. This will badly damage the company's liquidity. Cash flows would be affected in negative ways. The business may have problems having enough cash flows to operate. So that is the bullet loan. Looks attractive in the short term because all you're paying is just the interest. Alright, the principal is deferred to the end of the loan. Right, so that is the bullet loan. Let's go on and talk about the balloon loan. Now, what is the balloon loan? The balloon loan, as the term implies, is that the amount of payment over time gradually increases, and most parts of the loan is paid off towards the end of the loan. So as you can see here, as you approach the maturity of the loan, the amount of repayment is actually escalating, it's actually increasing. So that's why the term balloon is a ballooning loan. Well, the benefit of this is that Well, the payment amounts are small, right? Especially the initial payment amounts are small. So businesses would have, more room to breathe, and they have better cash flows, at least for the initial period, right? However, towards the end of the loan, the business has to budget for repayment. And this can be quite a bad shock to businesses which are not prepared to pay up the entire principal. Well, in such a case, if businesses do fail to foresee or prepare for the repayment of most of the loan, okay, when it comes towards maturity, then what can the business do? Okay, well, if let's say if it's unfortunate enough that the businessman didn't anticipate for the repayment of the loan, then he could consider a refinance. Well, a refinance simply could be in the form of another loan to pay off the old loan, or rather a new loan to pay off the existing loan. So that could be an alternative. But as far as we are concerned here, is that when you take a balloon loan, it benefits you or the business in the short term. However, in the longer term, you have to actually be mentally prepared to pay off the bulk of the loan towards the end. Towards the end of the loan tenor. Right, so that is the balloon loan. Quite interesting. Now let's look at the third one, which is actually the amortized loan. The amortized loan is what most of us will go through. Alright, if you have ever taken a mortgage loan or maybe a car installment, okay, and an amortized loan simply works like this. Okay, very simple mechanism or very simple structure. So in an amortized loan, the amount of repayment is constant. Yes, it's a constant amount of repayment. And not just that, each payment consists of two components. Okay, so in an amortized loan, there are many payments. Okay, and all payments of equal amounts, or you can say that each installment is of equal amounts. Each installment further comprises of two components. Okay, one component for interest, another component for the loan principal. In the initial years of the loan, the interest component will tend to be much higher, but as the loan gets paid off, the interest component in each subsequent installment gets lesser and lesser. Okay, while on the other hand, the principal amount that gets paid off increases as as we go along through each subsequent installment, as you can see here. So that's the amortized loan, and typically your mortgage loans would be in the form of an amortized loan. Well, the advantage of this is that it's extremely predictable. Alright, predictable payments. You know how much you'll be paying. You know when you'll be paying that amount. You do not need to worry about having to budget a massive sum of cash to pay off the principal at the end. Unlike the earlier loans which you saw, like for instance the bullet loan, which requires a massive amount of money to be paid out to clear off the principal, and unlike the balloon loan, where the business has to anticipate and prepare for a large sum of money to pay off the entire loan towards the end of the loan tenor. So the amortized loan gives a lot of predictability. Well, is there any downside? Well, of course the downside could be that it doesn't have the advantages of the bullet loan. Right, it doesn't have the advantages of the balloon loan. It doesn't have any, right? Because all the while the amounts that are being paid back for each installment is of equal amounts, right? It doesn't give the advantage of low cash payments in the initial period of the loan, unlike the bullet loan and the balloon loan. So there you have it, the amortized loan. And So that completes my short little coverage on the 3 types of loan. I hope that is informative to you, and do watch out for my next video. Alright, have a good day.